You're back in the loop. Now, let's go back to Bloomberg's Karl Yap live in Manila from the Bureau in Makati. Karl, good to have you with us. Now, let's talk about Indonesia's central bank. The rate cuts that they have may potentially set off a wave of rate cuts across the region, with the Philippines probably cutting against the grain. Could you talk about that scenario of when that might happen within the year?
I think the case of the Philippines is a bit different from the others in the region. Number one, it is one of the least exposed to global trade among Asian economies. And we have seen that growth in the fourth quarter actually accelerated at the fastest pace in a year. So in contrast to others in the region, growth is still pretty robust, right? And the central bank has announced, and they have been talking about their shift to the interest rate corridor. And I think it would be wise to expect that they would not do anything sudden until they implement that, unless, of course, something dramatic happens, right? You know, oil doubles or, you know, it falls dramatically. But, you know, given what we have seen so far, you know, they'll probably remain on hold until the first half of the year.
Okay, well, we'll get to oil in a bit. Yeah, we'll get to oil in a bit. I mean, the question I have also is, given the fact that you know, we're half right now of Indonesia's CPI. People are also looking at currency weakness, with the yen being the strongest in the region. Let's talk about what the sentiment of the current central bank is. Is there any cause for concern across the region, or are there levels so low that they're already happy that they're helping the economy in terms of exports?
I think in terms of boost to exports, we have yet to see these, you know, weaker currencies really help. In the case of Japan, we've seen that their exports have recovered in 2015, but it's, you know, we must remember that they started easing a long, you know, time ago compared to the others. So we might, we don't, it's not yet clear how long this export slump will last, or whether this currency weakness, you know, we are seeing right now will translate to better demand. One economist did mention, I think it's Glenn Maguire of ANZ, who says that the recovery in the advanced economies is really more service-oriented rather than goods. Yeah. So, you know, we'll have to wait for more data. Yeah.
That's probably hence why they're very passive on their currency policy and stronger in their monetary policy. Now, finally, Karl, the question I have is, with the signals on oil and exports being one of the key things for central bankers to look at, what other thresholds are policymakers and regulators looking at to be able to determine whether or not they're going to calibrate their monetary rates or even economic policy in general?
I think more and more, you know, policymakers are making references to what, you know, central banks in advanced economies are doing. We've seen, you know, Yellen, you know, make references to China, for example, or South Korea talking about monetary policies in advanced economies. So it's becoming more and more interlinked, and, you know, these closer ties between global financial markets. You know, we've seen the wave of volatility in the past in the past 6 weeks. I think that's what really key. Financial market volatility will weigh on sentiment. In the U.S., we've seen that economies have pared back estimates for a rate cut this year compared to a couple of months ago when they were expecting, I think, maybe four
rate cuts was the last estimate, yes. And some houses are now paring it down to around 2.
Sorry. My apologies. My rate increase.
Yes.
Rate increase, my apologies.
Yeah. And basically, you're also asking, some investment houses are now getting that rate increases down to 2 or half the estimate. So, Karl, thanks so much for your analysis. Look forward to it as the third quarter it comes in and the interest rate corridor kicks in as well. Thank you.